going into topic number two related, Timmy's now turned 18, by the way. He's just fast tracked like that. That's how he works,
Wow, life
Yeah,
flies.
time flies, and he's undergrad in business school. He's really excited, right?
Okay,
And one of his first courses he took was finance.
good
They have
luck.
now introductory to finance, and he's really excited for introductory to finance. And he comes to his money man, Zachary Rains. Zachary is now, about 50, 60 years old. He's really established, looks great for 50, 60, by the way. Well, way to go, Zach.
Thank you, thank you.
No problem. And then so Timmy says to you, I've been studying this stuff in finance and I've heard these terms on TV, but I don't really know what to do with this. Bonds, stocks. I want to make money, Zach. I've heard that bonds are a way to go, but I've heard stocks are a way to go. But to be honest, without Googling it or AI, I have no clue what the heck this is. So can you please explain to me in plain English what a stock is and what a bond is?
No problem. Yeah, no. Thank God Timmy hasn't looked it up on ChatGPT yet, or whatever version is there yet. So, a stock is a contractual right and ownership of a publicly traded company. What that means is every company who is publicly traded, meaning they are available for pretty much and the general public to invest in, has a certain number of shares, right? Think of it as a pieces of a pie, however you want to phrase it, that the average individual can own, corporations can own, funds can own. There's so many options as to different types of stocks you can invest in out there, but it's your share of a company's ownership. So if a company out there, let's just say Microsoft, everybody knows Microsoft, nice, big, beautiful company worth, billions and billions and billions of dollars. Anybody can go and purchase a share of Microsoft, and that what that does is it gives them a portion of Microsoft's ownership, which at this point, who knows, if they have a million shares, it gives them one millionth of a share, but we all know that it's more than that right now. And on top of that, what it does is it gives you a right to their earnings. So that's really cool. What that means is, let's say Microsoft has an amazing year. They decide to, buy whatever company that's got a revolutionary changing product, and their company starts selling, Microsoft starts selling tons and tons and tons of products. Well, if Microsoft makes, and another simple, for instance, if Microsoft makes $1 million, then your one millionth of a share can then earn a dollar. So that's net earnings. We're assuming this is money that they're going to give away. And there's so many more rules. But that's your portion of income, which is really cool because as an owner of the company, you're eligible to receive a portion of their earnings. Now, let's get even crazier. And let's say that Microsoft just developed the, flying car, right? We all seen the Jetsons, it's coming, right? Microsoft just developed the first flying car. Well, that's fantastic. Their earnings have now gone from $1 million a year to $100 billion a year. Okay. Well, now you get a portion of your one millionth of that share. And on top of that, the company, because they're earning so much more money, any other person wants to invest in it. They're thinking, wow, if Microsoft's going to keep making this kind of money, I'm going to be eligible to earn more and more money as my part owner. Well, that means that your share in value is more desirable. And just like supply and demand that we learned in first year economics, or potentially even in high school, Timmy, that means that more people are going to want your share, which means you can sell it for more. And that's a really, really valuable piece of investing in stocks. And that's how stocks grow in value. You can either grow through earnings and earnings potential, or you can grow in the promise. Let's just say the promise of a stock, the ability to, out of nowhere, produce the Jetsons lifestyle. So those are two different valuable ways to invest in stocks. Now, with that,
Gotta ask you a
naturally,
question about the stocks for a moment.
absolutely.
Okay, because so I wasn't crazy. So owning a stock, going to buy, let's say, for example, I sold two pairs of shoes and now I have $10,000 worth of Apple shares, right?
Mm,
So I'm an owner in the company, right?
mm,
So two things. I go down to the Apple store and I come in, I'm like, I'm the owner. I got, here's my shares, there's my value. I need a couple iPhones. Don't worry, just, write them off. I'm going to take them. They wouldn't hand me my phones, even though I'm an owner in the company. And when they have their board of directors meetings, I don't have a seat at the table. And apparently, I'm not invited. Like, what is going on with this, Zach? Am I not an owner of the company now?
So you are an owner of the company, but when it comes to companies that are publicly traded, there has to be a level of responsibility implemented outside of the owner. Why? Well, there's a conflict like you just presented, and then there's general bias. And again, there's so many more reasons that they implement things like a board of directors. Um, but as a part owner, you're eligible to invest and receive the earnings. You're not eligible to just take what you want. Now, the value in that is if you're going to buy an iPhone and you spend whatever it is, $1,000, well, the part of the earnings that Apple just earned is going to be attributed to you because you're a part owner. But you don't just get to pretty much do whatever you want. And because companies like, for instance, Apple, Microsoft, Alphabet are publicly traded companies, they have board of directors, which more often than not are generally chosen by the most influential shareholders. So they're not the people like you and I, which own one millionth of the company. They're the people who own 40% of it. They're, the Mark Zuckerbergs, right? Where Facebook, Meta now is still a publicly traded company, but everybody knows Mark Zuckerberg still owns whatever, 30% of it, 20% of it, and is a majority shareholder. So Mark Zuckerberg is going to be a person choosing the board of directors, and the board of directors does exactly as it sounds. It directs the company. So there's value in that, but I wish that I could just buy a share of Apple and then go get my own iPhone.
So that's how stocks work. So
Cool.
now, if I want to go the other route, these things called bonds, what the
Yeah,
heck are
so
what are those?
a lot of people will choose to go bonds or stocks or a mix of both. Stocks, the value in stocks is if you invest in very, well-known, renowned company, generally speaking, over time, the value should go up of your stock, and then therefore your investment produces a positive return. Not always the case. There are companies which unfortunately, hit a downtrend, and then next thing you know, they're just losing and losing and losing money. And there's a much greater risk associated with that, which is why some stock investments will turn people away and it will turn them more towards bonds. Bonds are really cool. And the simplest way of thinking of a bond is just as a piece of debt, right? It's just like any form of debt that any company has issued, any person has taken on, right? So it could be debt like your mortgage, debt like a line of credit, debt like car financing. And the reason I say that is because when a company issues bonds, or more often than not, and more popularly, a government issues bonds, what they're trying to do is raise capital for their purposes without giving away ownership, right? Which would be the stock route. What they'll do is they'll say, well, okay, if you lend us, let's say, we issue a bond for $1,000 to, let's say Timmy's going to say, okay, here, I'm going to lend you that $1,000, but the price that you're going to pay for taking this $1,000 as a loan from me is going to be, let's say $8 a month, every single month for the next 5 years. Okay, well, that sounds awfully similar to a mortgage, right? You go to a bank, they give you $500,000, and every single month you have to pay a portion back of the principal that they gave you of that $500,000. And on top of that, you have to pay interest. Well, it's the simplest way to think of a bond. And the value in bonds is that you have a claim to the company. It's essentially a liability, no different than a mortgage would be. And without getting into too many accounting terms, in doing so, and again, this is worst case scenario, if the company, whoever you loaned your money to, goes bankrupt, well, now you can start taking their assets, meaning you could start taking their stuff. So there have been cases where, Greece went bankrupt a couple of years ago, well, more than a couple of years ago, a few years ago. Many companies have gone bankrupt. And as a bondholder, you go in, there's a liquidation sale of all of their stuff. And you say, okay, well, they owe me this much money, and you get your money back, which is really cool. But more often than not, that doesn't happen. And what it will give you is small, regular income. We call it fixed income in the investment community because we know, for instance, every single month we're going to get that $8 back. And then after 5 years, we're going to get our $1,000 back as well. And that's a really, really cool form of investment because there's not too much risk to it. A government won't often issue bonds unless they know they can afford to pay back the return. So if, let's say, again, we're working with Microsoft here and they want to develop the hoverboard or the flying car, and they know, for instance, they need $100 million to start, right? They'll go, and instead of giving out more shares, more ownership rights for other people, they'll say, we just need $100 million. So let's give $100 million worth of bonds. And the return on an investment that we can give them is, I don't know, 6% a year. So we'll give them 6% of the 100 million back every single year until 5 years from now. And then a person will go and they'll know, okay, well, Microsoft is 50, 100, whatever it is, $1 billion company. I feel pretty confident giving them, a loan. So here we go. I'm going to buy a share of their loan. And that's really, really cool. And governments are very, very, very popular for issuing debt and these forms of bonds. So you'll find a lot of investment funds and a lot of really, really wealthy people buying government bonds because it's the greatest form of credit that you can have, right? You are the government, the regulatory body for everything, right? So you'll find a lot of people investing in those, and they're obviously much, much less risky in most cases than equities, stocks.
So, question, Zach.
Mm-hmm.
I go down to the Lamborghini dealership and I want a
Mm-hmm.
Lamborghini. Okay.
Me too. Yeah.
All right. And they said to me, okay, so, you're going to have to register a lien against the car. Do you have credit? And I'm like, no, I'm good for this. I take out my piece of paper and I wrote bond issued by Jonathan, IOU, value of Lamborghini plus 5% per year. I'm good for it. I swear. I sign it. I hand it over to them and they laughed at me. So I'm going to take it that not everybody can issue a bond because it sounds to me like a really sophisticated IOU note.
Well, everybody can issue a bond. It's considered a promissory note in its most basic form. Not everybody's willing to take it. I can tell you that. So with any form of debt, in order to receive debt or take on debt, for instance, you have to do some form of underwriting, let's call it, right? So a mortgage broker, you go out for a mortgage, or you go to a bank underwriting process. And what does that process entail? It's basically just saying, hey, what can you show us that you're good and you're honest and you can qualify for something like this? What can you show us to know that you're going to pay us that $8 every single month when it's your time to pay us? So, the Lamborghini dealership probably laughed and said, okay, well, we need to see some finances. And that's a whole different story. But you have to look at what people are offering in order to really quantify whether it's a good investment. So the Lamborghini dealership is going to look at your finances. Is this a good investment for us? Is this guy going to be able to pay every single month for his Lamborghini? And what you're referring to is commonly known as financing, which is just another form of a loan, right? People go in, they buy a car. If they can't afford the whole thing, no different than a home, they'll put a down payment. And then a company, not necessarily Lamborghini, but a company that Lamborghini works with, will finance the vehicle for you. They'll give you a loan for the marginal amounts, and you'll have to pay interest on it. No different.
So bottom line is stocks is owning the shares in the company and the bonds is lending them money and owning debt against them, essentially.
Yes.
Amazing.